Hello, my name is Garrett Gunderson with Archetype Mortgage. I've been asked a lot about temporary buydowns recently from buyers and agents, so I wanted to make a brief video explaining exactly what they are. To start, most loans use permanent buydowns with the non-refundable one-time fee at closing to buy the interest rate down for the life of the loan. Sometimes people pay a lot to do this, but when you sell the house or refinance the mortgage, that fee is not refundable. A temporary buydown is popular right now because it temporarily keeps payments lower for certain periods of time. This is generally paid for via seller credit at closing, and the money kept is prepaid interest on the mortgage inside its internal escrow account, which already takes your money for property taxes and homeowners insurance. The benefit is if you sell or refinance, and most people anticipate rates to drop in the next year or two, any unused portion of that prepaid interest is refunded at sale or refinance, so it is not lost. For example, let's talk about a 2-1 buydown. This means that the permanent interest rate, for example, is at 7.5%. The buyer's monthly payment in year 1 are equivalent of a 5.5% rate, year 2 at a 6.5% rate, and all the years after that at the 7.5%. So the first 2 years are being subsidized by that prepaid interest from the seller. Some other examples of this are a 1-0 buydown, where the interest rate is bought down only for the first year, a 2-1 buydown, where it's 2% lower the first year, 1% lower the second year, and a 3-2-1 buydown. And those ones are a little harder to get because it requires almost a 5% cost of the loan size to be paid by the seller. As of filming, this is November 2023, and just like the prior quarter fours of the last year and the year before, it is a buyer's market for a change instead of a seller's market. So now is your chance to actually go through and try and negotiate good deals with sellers right now. If you are trying to wait and time the market on interest rate, you are going to get bid out on price. It's a simple fact that if you wait until rates drop potentially to 5 or 6%, you're going to have a lot more competition bidding on those houses. So a $300,000 house you might be able to snag today with a temporary buydown, also heavily reducing your cash out of pocket, is also going to be maybe $330,000 if rates are 4 or 5%. Nothing is one size fits all. That's why it's important you work with a professional like myself so we learn about what your goals are in the short and long term in general with your finances, so we can structure the loan that best suits you for your house. Make sure to follow, subscribe, and like, and comment down below if you think I'm crazy, or if you like what I had to say, or if you had any questions at all. I love to interact.